Prospectus Review number 5, American Funds, Bond Fund of America, Part 3. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, St. Louis Test Prep, and the website. And the web page we're going to see in a minute is the Summary Prospectus for American Funds, which is right here at the bottom of the page. I'm going to scroll down to the next point I want to make, and I'm also going to pull up the Summary Prospectus for American Funds. This information we saw that you see on the screen on the last video. So here's where I'm going to start. Here's the link you can see at the top of the page, and this is the Summary Prospectus, which has changed in the last 10 or 15 years. Investment brokers can now sell mutual funds with a Summary Prospectus that is in a shorter version. If you want the longer version, you can go out and get the Statement of Additional Information too. So they start off, and we saw this on the summary page last time. There are lots and lots of different classes of mutual fund shares, classes, and this deals with how you pay both sales charges and also operating expenses, which I'm going to get to in just a minute. But before I get there, let me talk about the investment objective. The goal of the fund is to produce a high level of current income consistent with preservation of capital, which I said last time means that they want to make sure that particularly income investors get their original investment back whenever possible, because the idea is that these income investors may not be making a lot of income, may not be working, and they don't have the ability perhaps to make more capital to invest, so we want to make sure we secure that capital. Fees and expenses of the fund, and this is where I'm going to jump over to Excel. And I want to distinguish between different fees. First of all, I'm going to do share classes first, because that's usually the first thing that people think of is sales charges. So share classes have sales charges. That's what they relate to. And the common parlance is you can pay a, quote, front-end commission, which means that you pay a sales charge when you invest. You can pay a back-end commission, which means you pay a sales charge when you withdraw the funds, and that declines the longer you hold the funds in the product. Or you can pay on another schedule, so that you can see here, as I scroll down a bit, there are lots and lots of different structures, A, B, C, etc., to structure these sales charges. So as usual, they take an assumption down here. You're going to see beyond the percentages, an assumption about a certain amount invested, and they're going to tell you over time how much you would pay in cost to invest. So in the shareholder fees, you'll see sales charge or load. A share is the common one that started with in the mutual fund business in the 70s, 60s, 70s. You pay a 3.75% upfront load. You can pay instead a sales charge when you take money out, or you can pay different structures that I won't go into now. It gets pretty complicated. Annual fund operating expenses, on the other hand, are annual fees that go to two things. We go to pay the money manager, and the distribution or 12B13 fee is a fee to cover marketing, and also pays a small annual, what we call in the brokerage business, a trailer commission to investment reps. That's what that fee is for. When you go over to their chart here, you can see how those fees break out, but that's what we mean. And then if you go further, and I'm not going to spend too much time on it, you can see based on $10,000 invested, 5% return each year, here's what your costs would be. I'm going to skip through that because I think there's some important information down here we need to get to. Turnover I talked about in the last video, which is, if I scroll back up a little bit, the percentage of the total invested dollars in a fund that are sold each year in a given year. So for example, if you had $100 in the fund, during the year you sold $20 of the investments, that would be 20 divided by 100, or 20% turnover. The important thing I want to cover in this video are the risks to investing. And first of all, interest rate risk. And the risk is that if interest rates rise, currently issued or outstanding bonds are less attractive, and as a result, the price of those bonds decline. So here's an assumption. Why is that? Assume you own an 8% 10-year bond and rates rise. So now instead of 8%, a 10-year bond of the same quality is paying 9%. Well, the result is the 8% 10-year bond is less attractive and the price is going to go down. So now you need to do something as a bondholder to encourage buyers, and some of this is just supply and demand in the marketplace. Let's say you pay $950 for a $1,000 8% 10-year bond. Well, if you hold it till maturity, the bond says you get back $1,000 at maturity, so you'll have a $50 gain, the difference between the $1,000 and the $950 cost, $1,000 the face amount. So what's the result? Well, the result is that you get two rates of return. One return is that $50 gain on the buy and sell. The other is the 8% you earn in interest income along the way. So your total return, a new term, total return, which is another way of saying yield to maturity, might be 9%. So if you pay less than $1,000 for the 8% bond, you may end up with a total return that equals 9% that you can get on bonds currently. So there's interest rate risk in a bond. Interest rates go up, existing bonds go down. There's also risk depending on how long it is till maturity. The longer until the bond matures, the more price fluctuation you have. So it's like a seesaw. The further you're out on the seesaw, the more movement you have. A 30-year bond is going to change more in price and more dramatically in price than a 2-year bond, because a lot of things can happen in 30 years and there's less risk if it's only 2 years. Credit risk we saw on the prior video, the possibility that the credit strength of an issuer will weaken. Maybe a company's financials doesn't do well financially, they have less earnings, or maybe they take on more debt. And or the issuer fails to make timely payment of principal or interest or both, and the security will go into default. Default is defined as not paying principal or interest on a bond or both. Prepayment risk, which relates to mortgage-backed securities. Think about your own mortgage. If interest rates fall, the loans underlying the securities prepay faster than expected. Low interest rates, people refinance their mortgage, they pay off their mortgage. And now, when the new mortgage is set up for that client, it's set up at a lower rate. So the problem with the fund is that as people prepay their mortgages and refinance with low rates, the fund has to reinvest that prepaid principal in lower yielding securities. So now, because now yields are down, hurts the fund's income. The opposite is also true. Interest rates increase. People are going to hang on to those loans that have a now lower than market rate on them. So the expected time to pay off those loans is extended. So the fund has less cash because fewer of the loans are being refinanced or coming due. And finally, there's inflation risk, and I included this little blurb on Consumer Price Index. Consumer Price Index measures inflation, which is defined generally as the overall increase in prices over time. And if you can imagine a grocery cart filled with commonly purchased items, eggs, bread, butter, and that cart, that grocery cart of goods, is repriced every month. And as the price of that grocery cart goes up in total, that's how we measure inflation. Consumer Price Index. So you can see here that the fund, and I just went over it, risks of investing in bonds. They talk about interest rate risk. They talk about the debt security maturities. They talk about credit risk. They talk about prepayment risk. Down here in this section where we talk about asset-backed or mortgage-backed securities. They do make a distinction between government bonds that are issued directly by the Treasury bills, bonds, and notes, versus agency bonds, which are not technically backed by the U.S. government, although they have a AAA rating. So that sums up really what I wanted to cover on the summary prospectus. It does have performance information, but you can look that up on your own. I finally wanted to mention as I go to the top of the page that investors should carefully consider investment objectives, risk charges, and expenses. This and all the other information is in the fund's prospectus. Oops, sorry. You should get a prospectus from an investment professional and read it carefully before investing. Past performance is not indicative of future performance. And finally, this presentation is for educational purposes only. If I jump over to the website, take me just a second, you'll see that there's a page on the website now called Investor Education, and that I have live online sessions where I go over some of the larger, more widely owned investments. You can see, for example, that I'm doing a live chat on Growth Fund of America and this topic, Bond Fund of America, in June. These courses are ongoing all the time, and you can go to the website page at the top for more information. Thanks so much for watching, and we'll see you next time.